In this video, I am going to discuss about annuity. Annuity is the present value of cash flows over a specific number of years. All the payments are the same amount, which means annuity is the present value of future cash flows over a specific number of years. This means the number of years or the number of payments are specific, which means these payments have an end date. After that date, there will be no cash flows. Let's say you have taken out a loan. Every month you have to repay this loan. Usually the repayment amount is the same. Let's say $10,000 every month until a specific date. This is an annuity. What we do here is we calculate the present value of these future cash flows. These are the main characteristics of an annuity. You must know about these characteristics. Finite amount of time periods, which means there is an end date. Always remember annuity has a specific date or specific number of years or specific number of payments. This means, as I said earlier, after this date there will be no cash flow. We know for a certain these cash flows will end. The same initial amount will be paid or received every year until the specified time period reached. This means if the cash flow is 10,000 a year, this amount will not be changed, which means year 1 there will be 10,000, year 2 there will be 10,000. Likewise, until the specific date is reached, let's say year X, this amount will not be changed. These are the two main characteristics of an annuity. These will be tested in your exam. So have a better understanding of these characteristics. As the name suggests, annuity, we consider the annual payments, annual cash flows. We do not consider monthly, quarterly, biannually. We don't consider these cash flows. We are only considering the annual cash flows. This is the annuity formula. The present value of the annuity equals to initial amount multiplied by the annuity factor. This is the annuity factor. We discussed about the discounting factor under discounting. Like that, now we have an annuity factor. Using the cumulative present value table, we can find the annuity factor for respective discount rate. So capital F is the initial amount. This amount does not change. As I said earlier, if the initial amount is 10,000, all the other cash flows will be 10,000 as well. Capital A represents the present value of the annuity. This is what we are calculating, the present value of the future cash flows. R is the discount rate. As we know, this is an interest rate. N is the number of years. So this is the annuity factor. Like in discounting factor, we can bring this denominator into the numerator. So this will equals to 1 over r, 1 minus 1 plus r into the power minus n. This is the difference. These two annuity factors are the same. The only difference is the denominator has brought to the numerator. You can use either one of them. Both of them are the same. Now let's do an example. Let's say we have to pay option A $650 for 2 years and option B $1,000 for 3 years. Discount rate is given 4%. What we have to do is we have to calculate the annuity for these two options. Annuity is the present value of the future cash flows. Option A says we have to pay $650 for 2 years, which means at year 1 we have to pay 650, at year 2 we have to pay 650. As I said earlier, now there is a specific time period. There will be only 2 years and the amount is not changing. So these are the characteristics of annuity. For option B, year 1 we have to pay $1,000. In year 2 we have to pay another $1,000, and year 3 we have to pay $1,000. So this is also have a specific time period which is 3 years, and the amounts are the same, $1,000. Now let's calculate the annuity using the annuity formula. For option A, annuity equals to F. F is the initial amount, 650, multiplied by 1 over R. 1 over R, R is 4. We have to convert this percentage into a decimal. So 4 over 100 multiplied by 1 minus 1 over 1 plus R. Again we have to convert the percentage into decimal. So 4 over 100 N. N is the number of years or number of payments. We have to make 2 payments. So N is 2. Always remember, when it comes to annuity, there will be no cash flows at year 0. Starting from the year 1, there will be cash flow. So let's calculate the annuity for option B, equals to 1000 multiplied by 1 over 4 over 100 multiplied by 1 minus 1 over 1 plus 4 over 100 times 3, because the number of payments or the number of years are 3. Now let's refer to the cumulative present value table in order to find the annuity factors. So the discount rate is 4. So here is the cumulative present value table. This is not the present value table we discussed under discounting. This is the cumulative present value table. This is the table we are going to use for annuity. As you can see, here is the annuity factor. In the exam, carefully refer to the present value table and the cumulative present value table as per the requirement. Don't get confused with the two tables. We use the present value table for discounting factor and we use the cumulative present value table for annuity factor. These tables are two different tables. The discount rate is 4%, which is here. So number of periods for option A is 2. So here is the 2, 1.886. So this equals to 650 multiplied by the annuity factor, 1.886. For option B, there are 3 years or 3 payments. This is the 3. Number of periods 3. So the annuity factor is 2.775. So this equals 2000 multiplied by the annuity factor, 2.775. Now let's calculate the annuities for each option. So these are the annuities for option A and option B. So if you have to select one option between the option A and B, what would you select? We are going to pay this amount. These are the present values. So we select the option A because this is the lowest present value. Let's say we are going to receive this money. And what option would you select? We select the option B because this is the highest present value or the highest annuity. Likewise, now you know how to use the annuity for decision making. Annuity is simply the present value of the annual future cash flows. Now let's go one step further. Advanced annuity. Advanced annuity is a special case of annuity where there will be a cash flow at the start of the investment or project which means at year 0 there will be a cash flow. If you can remember now, under annuity there was no cash flow at year 0. Only beginning from year 1 there were cash flows. Here the advanced annuity is a special case of annuity. So the main difference is at year 0 there will be a cash flow. So this is the formula to calculate the advanced annuity. There has been few changes to the annuity formula we discussed earlier, which is now there is 1 here and n has changed to n minus 1. Let's discuss what has happened. Pay close attention. This simple n represents the number of payments, not number of years. Here is an example. Let's do this example so you will understand what is advanced annuity. We already know what is annuity. Now let's discuss about what is advanced annuity. Calculate the present value of $200 advance annuity of 5 payments. Discount rate is 5. Simply this means there will be 5 payments. Each has a value of $200 and the discount rate is 5%. We have to calculate the present value. As now we know, under advanced annuity, there will be a cash flow at year 0. So, year 0, there will be a cash flow of 200. And always remember, count the number of payments. Do not count the number of years. So, there will be 5 payments. So, this is the first one. This is the second one. This is the third one. Fourth one. Fifth one. Now all set because there are only 5 payments. Now let's assign the years. Year 0 is here. Now year 1, year 2, year 3, year 4. As now you can see, even though there are 5 payments, there is only 4 years. This is the bit tricky part of advanced annuity. So always count the number of payments. Do not count the number of years. So now we can calculate the annuity for this advanced annuity. So advanced annuity equals to the initial amount. Initial amount is $200. As now you can see the amount is the same. It is not changing. And we know for a fact after the year 4 there will be no cash flows. These are the characteristics of an annuity. Here the only change was there is a cash flow at year 0. So coming back to the formula, 200 multiplied by 1 plus 1 over r. R is 5%. Let's convert this percentage into decimal. 5 over 100 multiplied by 1 minus 1 over 1 plus r. R is 5 into the power n minus 1. Always remember this is not n minus 1. So n is the number of payments. N equals to number of payments, not number of years. So how many payments are there? There are 5 payments. So n is 5 minus 1. So this is the formula. As you can see, this is the annuity factor. Even though we are discussing the advanced annuity, the annuity factor is still there. The only change has happened is now we have to take the n minus 1 value. So let's write this again. 1 over 500 multiplied by 1 minus 1 over 1 plus 5 over 100. Now it is 4. This is the annuity factor for the advanced annuity. Using the cumulative present value table, we can find the annuity factor for this. So we can refer to the 5% column and n equals 4 row. because here the n is 4. So the fourth row will give us the value. Let's refer to the cumulative present value table. The interest rate is 5%, which is this column, and n equals to 4, which is this row. So this is the annuity factor, 3.546. So this annuity factor equals to 3.546. Now we can simply calculate the advanced annuity using this annuity factor. So advanced annuity equals to 200 multiplied by 1 plus the annuity factor 3.546, because we already found the value for this part of this formula. This is the annuity factor. The only segments we have left is 200 and this one. So this is this 200 multiplied by parenthesis 1, which is this, plus the annuity factor. Annuity factor is this. So now we can simply calculate the advance annuity. So this equals to 909.2. This is the advanced annuity. This is the answer. What is the difference between the advanced annuity and the annuity? Advanced annuity has a cash flow at year 0, whereas under annuity there will be no cash flows for year 0. It is the only difference. I hope this is clear now. Now you have a thorough understanding about annuity and advanced annuity. And now you know how to use a cumulative present value table. Do example questions using cumulative present value table. So you will get the hang of it. And in the exam, you will be able to save time. Thank you for watching. See you in the next video.